In late June of 2020, India made a highly publicized economic retaliation. They blocked 300 Chinese applications, including TikTok, effectively twisting Beijing's economic arm in full view of the global press. While the public focused on Chinese apps, another power moved in. Japanese capital flowed heavily into India's banking, IT, and logistics sectors. Over a few years, this investment grew 11-fold, filtering deep into familiar icons like Flipkart, Swiggy, and Meesho. When billions of foreign dollars embed themselves into a nation's core strategic sectors, it raises a critical question. Is this a partnership for mutual growth, or are we witnessing the buildup of a deep economic dependency? To understand the risk of dependency, we have to look at Jakarta in 1997. During the Asian financial crisis, thousands of businesses burned and millions lost their jobs as the Indonesian economy collapsed almost overnight. The Indonesian rupiah lost 80% of its value in a matter of months. Citizens woke up to find their life savings virtually worthless as hyperinflation gripped the country. In the early 90s, Indonesia was a success story of cheap labor and fast growth. But the foundation was flawed. The entire boom was built on foreign loans. The moment global investors sensed the risk, they pulled $5 billion out, and the entire system imploded. We are seeing a massive, aggressive influx of Japanese wealth pouring into India right now. It forces us to consider if this capital is building a stable future or an invisible vulnerability that mirrors Indonesia's fatal flaw. To evaluate that risk, we have to look at why Japan is sending this money. Despite its massive accumulated wealth, Japan's internal economy has been stagnant for decades. They are trapped in long-term deflation. This traces back to 1989, when the Japanese stock market hit a peak frenzy and then violently burst, destroying domestic investor confidence for a generation. Land prices plummeted. Citizens couldn't pay their debts, causing failing bank loans to paralyze the financial system. It triggered a prolonged period of economic stagnation known as the lost decades. That crash created a reality where consumer prices drop, yet demand stays dead. In many areas, houses are being sold for effectively nothing because the demand for real estate has vanished. The crisis is accelerating because the population is naturally shrinking. Today, 30% of Japanese citizens are over the age of 65. With a retiring workforce and dropping birth rates, the domestic consumer base is disappearing. Japan generates massive capital because of its high savings rate, but there are practically zero profitable investment opportunities at home. That money has no choice. It must leave the country to find returns. But Japan can't just park its money anywhere. Escalating territorial disputes in the East China Sea have forced Japan into a tense naval standoff with Beijing. This creates a paradox. China is Japan's most severe military threat, while also being its largest trading partner. To break this reliance, the Japanese government launched a $2.2 billion relocation fund. The goal is to incentivize their corporations to pull their supply chains out of China and move them to safer hubs. This makes India the logical destination. It offers a massive market with 65% of its population under the age of 35. The alliance is a structural fit. You have a deflation-trapped nation with excess wealth and a shrinking demographic, meeting a capital-starved nation with an expanding youth population. Which brings us back to the Indonesian collapse. Is India walking into the same debt trap? A critical difference is currency. Indonesia borrowed strong US dollars. When their currency fell, debt became unpayable. India secures loans in deflationary Japanese yen, easing repayment. The second difference is asset type. Indonesia funded short-term consumption. India locks Japanese capital into long-term hard infrastructure. This strategy is visible across the country. Mega projects like the Mumbai Trans-Harbor Link are built using long-term, low-interest Japanese loans. With the capital, Japan transfers advanced manufacturing and transit technologies. Between 1991 and 2007, India received over 800 distinct technology transfers, helping build local capacity. By focusing on infrastructure rather than fleeting consumer trends, India is using foreign money to build permanent systemic capacity. This doesn't mean the path is clear. Despite the capital influx, projects still choke on regulatory delays, complex land disputes, and logistical drag. Compare this to Vietnam and Singapore. They used foreign capital to build highly efficient, frictionless global export machines. They didn't just build factories, They built an entire system that was easy to invest in. India's test is whether it can streamline its unpredictable policies to convert this influx of Japanese wealth into a globally competitive manufacturing sector. If India leverages this capital surplus for its industrial foundation, it won't just solve infrastructure problems,